Good morning, everybody. Thanks, Rusty. Just to add a little bit more information about our company, we've been established since 1995. I've got two offices, one located in Fortitude Valley, which I'm the owner and director of, and one based at Southport. We'd be the longest serving finance broking company in the management rights industry, and our core business is helping people like yourselves find money to buy management letting rights. Over the years, it's fair to say, combined between the Gold Coast and Brisbane office, we've funded more than 1,000 transactions. We've seen a lot and had a lot of experience in, I suppose, the pros and cons, and we've got clients who, now buying their third or fourth management rights over that period, and it's good to see. I was just saying to Christine before that a lot of my time now is taking up, obviously, with new people, but it's good to see that my existing clients are very busy as well. They're adding to their existing business, buying a smaller complex, growing that business, selling, upgrading. So it's a very good sign that they're very confident and comfortable within the industry, and I suppose exploring and taking further risks and increasing their education as well. So yeah, it is a very good sign. There's no cost to you to use our services. We're like a mortgage broker. The bank pays us our income. I think the stats are now about almost 5 out of 10 people will actually go to a broker to source money these days. I'm an ex-banker myself, so I know I've been on both sides of the fence. It's important for me to let you know that I do hold an Australian credit licence. We are regulated by ASIC, so like a lot of industries these days, it's all about disclosure and making sure we're servicing you under the legislation requirements. My presentation today is based on common questions that I get asked as a finance broker. But I'd also, along the way, I'll share some examples and experiences with you, which hopefully will answer some of your questions. So, very simple. Why borrow for management rights? Well, effectively, these two examples that I'll show. If you had a cash of say $400,000, it would be quite uncommon to find a management rights where there's a unit attached to that these days. They do exist, but it's very uncommon, so it's fair to say that also that developers now, and also with the new legislation change, you don't necessarily have to live on site and own a residence. So, it's very common now for especially the small to medium-sized management rights where there's no real estate. It's just a live off-site, or you might rent a unit in the complex. The business might be worth, say, $400,000. We have to budget for costs. Costs will be about $25,000. Now, the biggest cost is stamp duty. Queensland's stamp duty. It's applicable for a going concern business. Off the plan startup, in most cases it's not applicable, but you have to pay GST. So you'd be looking at about $425,000. The net income on that might be around $90,000, give or take. It might be more or less, but just for this slide I've said $90,000. The difference with that one is you've got no place to live. So as I said, you're either renting a unit in there, so out of that $90,000 you'd be paying rent, or you might have another house that you're living in, you might have a mortgage on that, so you've got general living costs and mortgage costs under that scenario. The next slide, what happens if you use your capital and you go to the bank and you want to use some of their money as well? Well, simple terms is that you're going to be able to gear up and now be able to buy a bigger business and potentially with a bigger income. So on a $400,000 investment, you could qualify to buy management rights for around about 1.2, roughly. Costs will be about $65,000. And again, stamp duty is the biggest cost. You've got stamp duty, legal fees, accounting, borrowing costs, cost for your licence. So generally we sort of work on, it used to be 5% of the purchase price. Now we say 6% because stamp duty's increased. But I found that 6% is normally overestimated. So if you budget for 6, you should be okay. If you put in cash of roughly around that $425, income will be about $165, interest on your loans about $50, so you're left with roughly $115,000. The difference with this scenario is that you've also bought yourself a place to live, so you don't have any other additional costs in relation to renting or if you've got a mortgage on your own house. So essentially you should be left with more money by using the bank's money because you're gearing up and buying a bigger complex. But the beauty about this industry is that there's so many different types of businesses where people can actually pick and choose to suit also their lifestyle, not just for a financial reason. We've all got other commitments with children or family or other jobs, or your preference where you want to live, how big's the manager's residence. So all that gets taken into account. It's not just purely about the numbers. How much can you actually borrow? Well, if you work out your cash amount, if you multiply that by 2.85, that'll give you an approximate amount of what you'd qualify for a purchase price of a management rights business. Or another way of looking at it, if you know the purchase price, you can then work backwards and say, well, the bank will lend up to 70% of the value of that business. There's a couple of different ways of how banks work out when they're borrowing money, but two key points are you must have a certain amount of deposit and you must be able to show you can afford to pay back the debt. But for today's exercise, we'll just say 70%. As I've said before, you may be looking at buying off the plan. It's not very common for people to buy off the plan start-up business if you don't have any experience. It's a tough ask to ask a bank to support that. It has been done, but it's tough. And not only that, I'm sure a lot of the business brokers would say today also that it's tough also to convince a developer to sell a management rights to a person who's had no previous experience. But banks they definitely lend off the plan. It's all on cash flow projected income. It's based on estimated rents and how many's in the letting pool. The contract's conditioned accordingly. Some banks are more aggressive in that space. Some are less aggressive. Banks will lend up to 100%, so if you've got additional security, and I'll touch on this more in a couple of slides. It's a very common question that I get asked. There's lines of credit available, redraws like home loans. Because there's a component of a house and a business, you do get a flavour of residential lending and business lending in some cases. So banks will offer redraw facilities and offset accounts just to be competitive, interest only. My last point there, another sideline of our business, which I won't go into great detail today, it's not the idea of it, but just to let you know that we do have options for some people that have got the expertise to run these businesses but don't have the necessary capital, and we do match people up to form the required capital, and you become a partner in a management rights business. Okay, so borrowing against property. Look, this is very common because, a lot of people obviously do own houses, residential property. You might own two properties, you've got your place that you live in, you might have investment properties. The thing I will say though, is when you're borrowing 100%, so you're not putting cash in, you're using equity, the income from the management rights, in majority of cases, almost all of cases, but in majority of cases, is not going to be sufficient to prove to the bank that you can afford to pay back your debt. So they're looking for a secondary or a third source of income to prove affordability. So if you said to me, what's the perfect scenario for a lender and what's the perfect scenario for you as a business owner and a borrower, the perfect scenario is that you put cash into the transaction, you put 30% plus costs, or another way of looking at it, if you can pay for the manager's residence in cash, then all your debt is business related and the income from that management rights is sufficient then to prove affordability and give you enough money to live on, to pay off debt, to pay tax, to put money in super, all that type of thing. But when you're getting into a transaction where you're using equity and property, we need more income because your debt level is obviously higher. So if we use an example and say, if someone's got a house worth $400,000 and they own it outright, the bank will allow you to access 80% of the value of that property. You can't access 100%. So therefore, you can access $320,000. So that $320,000 becomes your deposit. That $320,000 would allow you to buy management rights for roughly about $900,000. The net income on that business might be around $120,000, $130,000. You would move out of your house, I would presume. You'd live in the manager's residence. So now you've got a rental property. You could rent out your residence, say for about $18,000, $20,000 a year. You pay interest on your loan of $57,000. You're left with about $80,000. So you can see there you've geared up, you've moved out of your house, you've got two income streams, a management rights business and a rental property. Where it can get a bit tricky is if you've got debt on your house, because then the rent that you receive ends up just going towards paying that other debt, and in that case you may need a third source of income. And it is common for, and I'll use an example where a husband and wife might be working full time, they've got kids at school, they're forever Monday to Friday, is busy. They look at management rights, it's going to give flexibility. They live at home, they've got a home business, a management rights business, they've got an income stream attached to that. The wife might be able to give up her job, the husband doesn't want to work, in the management rights, he's happy to keep his own job. The business might only be suited to a one-person operation. So that type of scenario there is very common, and it does work. The asterisk there, letter of credit, I think there's someone here from New Zealand, but just to add to that, if you do have property in New Zealand and you need to use the equity in those assets, we can do that without you having to sell your house. And in some cases, we can do that without you having to actually go to your bank to borrow the money. We do a letter of credit or a bank guarantee, they call it, where your bank in New Zealand talks to the bank here in Australia and offers a guarantee for your deposit, and that becomes the security then to the Australian bank. So that's one way around having to sell down and liquidate your assets in New Zealand. So, yeah, that's borrowing against property. Now, what happens if you sold that property? Well, if you sold the property, now you've got cash of $400,000. You'd buy management rights for around 1.140. Income's 160. There's no rent because you've sold your house. Interest is less because you've got less debt, and your overall profit now is 112,000 compared to about 81,000. So it's just simple maths. You've got less debt at the end of the day, less gearing. There's more income there. But it's not for everyone, because some people, it's very difficult to determine whether you should sell your house or keep your house. And I was only talking to a gentleman before we came in here that it's not only from a numbers point of view, it's a inconvenience, because do you sell your house first, but you haven't got a management rights yet? So you sell your house and you've got nowhere to live, and then you've got to transition to rent, and you eventually find a place and you move again. So, and that's why it's common for me to meet a person today, and it could take 12 months before you actually end up buying, because you've got your whole life to sort out along the way and sell property and so on. Yeah. Look, the bank's view, Frank did touch on this before. Look, fortunately enough, I've been involved in this industry now close to 13 years, and in my time, there's been a few little ups and downs, but when you look at the graph, it's been very consistent, and the graphs move this way. The banks have been very aggressive with the management rights industry, and they like lending money to it. There's a low fallover rate. As I said before, that on a perfect scenario, if you put money in, pay for the unit, the deal stands on its own 2 feet, the cash flow's there, bank's happy, you're happy. Normally, as long as you're making repayments, the bank won't interfere. They may review your loan every year, but that's no big deal. They just want to get an idea of what the letting pool's at, the income, and providing there's nothing there that's really adverse, the bank won't bother you any further. The big positive to the bank is the body corporate income. It's guaranteed income. You don't have any other business or any other industry that I'm aware of where you get this guaranteed income. It takes a lot of the risk out of it. Body corporate income is normally sufficient to prove to the bank it'll cover your interest payments. So if you did lose all your units out of your letting pool, there's still enough money there to cover the interest from your body corporate salary. That's another simple way of looking at it. The industry is highly regulated. You need a licence as a trust account. You're accountable. You get audited 3 times a year. When you buy these businesses, it goes through a valuer, a bank, an accountant, a lawyer. So, and the banks recognise all that as well. So, there's legislation in place for lot owners, on-site managers, body corporate managers, committees. So it's very transparent, and that takes the risk out of this industry as well. There's a link between the business and residents. We all know banks like lending against real estate. Most of these businesses have real estate, so again, there's a bricks and mortar component. There's a low fallover rate. There's no stock, like some businesses. There's no debtors. You don't need an overdraft. So again, it's just reducing the risk. Of all my clients that I have, and I've done more than 500 transactions, and that's not exaggerating, with my loan book, I have got one person who's in loan default. So that gives you an example of how solid it is. I've got money invested in management rights myself. I'm a big believer in the industry, and I've seen it. It's proven. I'm sure there's things in there that you need to be aware of, and banks will make you aware of it. I'll make you aware of it. But essentially, it's a people industry, and as long as the bank's happy with your communication skills and you've got the equity, most people succeed. Not working.
Broken my computer.
I have. just quickly talk about fixed rates. A lot of my clients aren't, I must admit, they're not really looking at fixing. Maybe about 18 months ago there was a lot of talk about it. We're in a market of rates going down. But I say the same thing to you as I say to my clients, that at the end of the day, don't try and fix a rate because you're trying to guess where the interest rates are going. It's a good chance you'll get it wrong. Banks pay their staff an enormous amount of money to pick these markets, so if anyone's going to get it right, it's probably a bank. But if you're going to fix a rate, just fix it just for peace of mind that you know what your cash flow is going to be. And you might fix some and leave some on variable, so you've got some flexibility. But you do lose flexibility when you fix. And you know, an obvious example would be if you've been in your management rights for 3 years and you're deciding to maybe selling in the next 12 to 18 months, well, don't go and fix your loan for 3 years, because if you do, there's a good chance that you'll be up for a hefty prepayment cost to get out of that loan when you need to go into the bank and say, well, I've sold my complex, here's a cheque, can you pay out my loan? So that's where you lose flexibility. You can't pay down debt outside those contract terms. But yeah, as I said, I mean, banks don't generally get it wrong, so just be careful of that. But there are some, in saying that, there are some quite competitive fixed rates in the market, so it's definitely worth exploring. Look, I touched on this before, just about a common scenario, and I often get asked this question about, you know, who buys these businesses? Well, when you look at the makeup of predominantly the clients that I deal with, it is a scenario where, and I'll use that term of the husband and wife buying a business, and maybe one of them wants to keep their job or work part-time, so they buy a business that might be a two-person team, but it might make sense for the husband to keep his job and just pay a caretaker to look after all the common ground and do some lawn mowing. But predominantly it's a husband and wife, they're using cash or equity. It's common with the house scenario. When do we sell the house? Do we need to sell the house? By selling the house is obviously going to just allow you to buy a bigger complex because you've got access to more money, because with, as I said before, with the house scenario you can only access 80% of the value. People buy these businesses, it proves their living position in relation to you've got a home and a business attached. It creates flexibility. It can help build equity faster, because now your mortgage has been turned into a business debt. You've got income that's been generated, whereas before you may not have had that. There's smaller businesses that suit couples, families, single people, first-timers, retirees. You know, you can buy businesses with 20 in the letting pool up to, 400 or 500 in the letting pool. So there's a whole range there. And the larger businesses are the same, suited to all different types of people, coming from all different types of background. You don't you don't need management rights experience or even property management experience to buy these businesses, and the bank recognises that. Some concerns just on the lending side of things. Look, it just pays to shop around. It just makes sense. The setup costs can vary. The least expensive is not necessarily the best. Don't just be driven by price. I've seen people do that, and they find that the rate that they were offered in the first year, when the bank goes and reviews it after 12 months, all of a sudden, just by coincidence, the bank's had a change of heart about their risk model, and now management rights, the interest rate's going to increase by X. So the cheapest on paper, it just wasn't the cheapest at the end of the day anyway. Also need to look at the conditions the bank's actually putting you on with those, with the lending. And again, as an example, every bank will have a requirement that you need to meet, an ongoing position in relation to your income and letting pool. It doesn't matter whether you've got a small business earning $50,000 or a larger business earning $1 million a year. There's benchmarks that you need to meet, and those benchmarks can vary from bank to bank. And as an example, one bank in particular has got a condition where if your letting pool drops by 5%, you're in breach. That doesn't mean that they're going to sell you up, because letting pools can drop and your income can still increase in other areas. So it's not a time for concern, but it's a trigger for the bank then to come and ask you for lots of bits of information and make you jump through hoops that you didn't really need to jump through. Other banks have got conditions where your letting pool only has to be if it drops by 15%. So it's just being aware of what the banks are offering. It's not just about price. Frank touched on before about accommodation module and standard module. Maybe someone else will go into that in a bit more detail. But at the end of the day, accommodation module is a 25-year agreement and a standard module is a 10-year agreement. So when the bank looks at lending money, it's all about repayment of debt and how long is that debt going to be paid off, what the term is, and the term can reflect the remaining time frame of the management and letting agreement. So to put it simply, if you've got a 10-year standard module, which they're not as common, they're around, that a bank is going to look at your repayment affordability, some of your debt over 10 years, which in some cases makes it harder to prove to the bank you can afford the loan. The bank, I'm not saying the bank won't give you the money, but it's just a different way of the bank working out difference in affordability on a 10-year agreement and a 25-year agreement. Okay, loan structure. This is important, and if you do take one thing home today, just try and remember this if you can. But and it can get a little bit confusing. I said before about the bank lending 70%, but when the bank actually structures their loans, they've got two assets. One's a house and one's a business. And just for competition reasons, they try and offer you the lowest rate because they know that another bank will do the same. So they say, well, some debt against the unit will attract like a home loan rate, and any debt against the business will attract a business loan rate. So you've got what I call a flavoured rate. One's lower, one's higher. But just because the bank is using your house as security and they'll set up a loan against your house, it doesn't mean that the debt is being used to buy your house. And I'll give you an example. If you buy management rights for $1 million and the unit's $400,000 and the business is $600,000, and you put in $400,000 cash, well, your accountant, Sam, would no doubt say to you, well, that $400,000 cash has gone towards to buy your unit because that's your principal place of residence. Therefore, when you go to the bank, you say, I need $600,000, so therefore your debt would be business related, so it should all be tax deductible. Understand that? But when the bank splits their loan, they'll split it in two because they can give you some debt on a low rate and some debt on a higher rate. But the loan entity should be in the name of the business, and the purpose of the money should be for buying the management rights business. So it's no different if I own my house and I borrow money for shares. I've got no debt against my house and I set up a loan for $100,000, I put it in the share market as an investment. That purpose that I borrowed is for investment purposes, so it should be tax deductible. Same with management rights. As long as you can show that you've paid for the house and the purpose of the money is for the business, it should be tax deductible. It doesn't make any difference what security the bank's holding. So I hope that makes sense, but I know Sam will touch on it as well. But as I always say, you need your accountant to confirm that because I can't give tax advice, but at the end of the day, that's what I will work with you and the bank and your accountant to make sure that that's set up correctly. Very, very important. I have seen people down the track go to their accountant and haven't claimed tax on a debt for 4 years. But that debt was tax deductible. They've lost a lot of money. So it's very important. Look, just winding up now, the process. First step is to talk to a finance person. You need to know how much you can borrow. There's no use going looking at complexes if it's out of your price range or if you could afford to borrow more money. Very, very important. With my business, my company and my staff, we are very conscious of the fact that in the early stage of the process, you need to have a very good understanding of what your borrowing capacity is. And we also understand that during that process, it's a process of elimination. So, you know, of a night time when you get home, you'll be looking on the internet, you found this one, you email them through to me, I look at it, I come back to you the next day, show you how the numbers work out. Yes, you can afford it, no, you can't afford it. If you're happy with the numbers, you phone up your broker, we need to have an inspection because you already know that you've looked at the numbers, you're happy with it, the bank's happy with it. All you need to do now is be happy with the business and you can make an offer. You need to have confidence in your bank or your broker. Look, I see time and time again, I deal with banks every day. They don't do it intentionally, but they just don't disclose everything. Or they disclose it in a way where it's hard to understand. It's got to be transparent. Any information that you get from me, you'll have all the information, fees and charges, nothing's missed. You need to know exactly what you're up for in costs. And we're there to communicate with your lawyer and accountant along the way to try and make the process as easy as possible. Look, just related entities, finance, lawyer, accountant, real estate agent. Insurance is important, professional indemnity, public liability, but that's normally the steps you take. Last but not least, just a little bit of advice. Do not test the water with both feet. With money you can buy a house but not a home. With money you can buy a clock but not time. And with money you can buy a book but not knowledge. And at PCS we can help you with all those. So thank you very much. And if any questions, we do that at the end, I think. Yeah. Okay. Thank you.